Welcome to Takeaways. My name is Jordan Brooks, Director of Market Analytics for ALN Apartment Data, and this month's newsletter was titled Tracing the Contours of Improved Apartment Demand. The idea with the newsletter was basically to give a breakdown of what we've been seeing on the net absorption front. One of the main stories this year for multifamily, in addition to new supply finally slowing down a little bit, has been the surge in demand that we've seen. Really, we're on a 3-year uptrend in net absorption at this point. But what was interesting about 2025 so far is that uptrend in demand has actually picked up some steam this year, which was a little bit against expectations coming into the year. So one of the areas that I didn't touch on in the newsletter itself was a regional view. We looked at national net absorption, we looked at price class net absorption, and then we also looked at markets of different sizes, so primary, secondary, tertiary, and micro markets. But just quickly, regionally, if you look at NAA regions across the country, for example, that's usually an easy way of breaking that down. All regions have seen improved net absorption this year over last year. So again, that one of the main sort of takeaways of the newsletter was just the widespread nature of the net absorption improvement that we've seen in recent months. That also holds just from a purely geographic perspective. But one aspect that wasn't touched on in the newsletter, and we may end up actually putting up as a longer form blog post, is lease concessions. So, there sort of myriad reasons why we've seen improved apartment demand this year. One of them undoubtedly is the lease concession environment that we're seeing. So just nationally for conventional properties, about 21% of properties were offering a discount for new residents at the end of September. That's a higher rate of availability than we saw during the sort of the pandemic era peak. And if you look at the average value that's being offered, it's about a month off an annual lease. So it's something like 7.5% off an annual lease. So a month free and about 1/5 of conventional properties offering a discount. Now, when you isolate just the lease-up properties, that goes to almost 40% availability with an average value of 6 weeks. So certainly for the lease-up properties, lease concessions are a big part of what's driving some of that net absorption. And in fact, if you look at net absorption in lease-up properties versus stabilized properties, about 3/4 of net absorption over the last 12 months nationally has come in the lease-up properties. So a majority of the demand is coming in lease-ups, and those lease-ups are really relying on lease concessions at the moment. Now, of course, below the national level, there are big differences at the market level, in particular markets that have seen sustained high supply for a number of years at this point. So I just wanted to point out a couple of examples. In Charlotte, for example, if you just look at all conventional properties in Charlotte, about 23% offering a lease concession. So not far off the national average, but the average value is almost 5 weeks off an annual lease. So about one additional week relative to that national average. And then a market like Austin, 50% of conventional properties are offering a lease discount, and that's an average value of over 5 weeks off of an annual lease. So again, we've seen a nice surge in stabilized demand this year as well. It's not just the lease ups. The stabilized properties have turned around in terms of their net absorption over a year or even 2 years ago. But again, even those stabilized properties are relying pretty heavily on lease concessions to drive that demand. And so one of the main points there is that as we move forward, as we look 6, 12, 18 months from now, as these leases start to expire and it's time for renewal, there is a little bit of question as to how sustainable this demand surge is if it's too dependent on the lease concessions that we're seeing. Now, just to wrap up, we are seeing pretty notable occupancy improvement because demand has gone up, supply has come down. We're anticipating supply going down further in 2026. And so this may sort of all come out in the wash where lease concessions start to recede as occupancies are growing. And when you don't have that same pressure from the new construction pipeline, there's not the problem that cooling absorption would provide in a high supply environment. So all that to say, net absorption trends are looking good, but lease concessions are certainly a part of that conversation and bear watching. As I said, we'll probably put up a blog post in the coming week or 2 weeks diving deeper into lease concessions. So look out for that on alndata.com/blog. In terms of upcoming events, October 30th, I'll be doing a webinar for the Arizona Multi-Housing Association. And then December 2nd, I'll be doing an ALN hosted webinar looking at 2025 multifamily performance and what it means for for our expectations for 2026. So for both of those webinars, be on the lookout on our social media for registration details. Just search for ALN Apartment Data on your social media of choice. And with that, I'll see you next month. Thank you.